Hello everybody, welcome to another one of our videos. The point of today's video is to educate you about gold, to provide some historical perspective about the precious metal, how it has done in the past, and probably answer the key question, how much gold should an investor have in their diversified portfolio? The first chart that we wanted to share with you is the price of gold adjusted for inflation. That is after we take inflation out. This is the price that we should be concerned with as investors because we want to earn at least, if not more, than the rate of inflation on our investments. As you can see, from the late 1970s to about 1980, the price of gold was in a tremendous bull run. In fact, it went from about $289 to about $3,500 adjusted for inflation. So that's more than a 10x in a very short period of time. What happened after that, from 1980 to about the year 2000, was that gold actually adjusted for inflation had the total opposite run. It went from $3,500 all the way down to $500. That is, it lost about 85% of its value. And since then, since the year 2000 till now, year 2025, so about 25 years, the price of gold adjusted for inflation has gone from $500 back to actually its all-time high in the 1980s, adjusted for inflation, roughly $3,500, i.e. it has 7x over the past 25 years. Now that we have shown how gold has these massive bull runs as well as bear runs that last many, many years, we would like to answer the question of why gold should be part of a well-diversified portfolio. We will provide you with 3 reasons. The first reason why gold should play a higher role in a well-diversified portfolio is that the price of gold is most likely going to increase in the long term. And the reason for that increase is going to be the buying pressure from the world's central banks. This is the diagram showing the share of gold reserves as a percentage of total central bank reserves going all the way to 1964. As you can see, in 1980, most of central banks' reserves around the world were held in gold. About 65% of the reserves were held in gold. Over the next 25 years, that ratio has declined to about 9%, but soon after the financial crisis, that ratio has continued to increase, showing that banks are continuing to buy gold and hold it as a reserve, and are often, especially recently, diversifying away from dollar-denominated assets. The second reason why gold should be part of a well-diversified portfolio is because of its diversification benefits. If a portfolio is well constructed, it's not only going to have assets in it that move in the same direction. It's going to have assets that zig while others zag. That is the exact essence of gold. The blue line shows the correlation of gold between a typical 60-40 portfolio, which a lot of investors have, and as we can see, the correlation is often negative to sometimes a little bit positive. The overall correlation between gold and a 60-40 portfolio over this 25-year time period is actually slightly negative. That means when asset prices like stocks and bonds are going up, gold is actually slightly falling in value. And that is what is an essence of a well-diversified portfolio. When some things are going up, other things are going to be falling. So the second reason why gold should be included in a portfolio is because it is negatively correlated to a typical 60-40 portfolio. The final reason why gold should be part of a well-diversified portfolio is that it acts as a hedge against inflation, so that your purchasing power when you hold the bar of gold is the same as it was in 1900 as it is today. Cash, on the other hand, is not a very good hedge against inflation. The main reason for that is that the Federal Reserve can always print more dollars, causing the real value of the dollar to decline. Gold does not have that problem because there's only a finite amount of gold that is in the world. No more gold can be dug up, okay? No more gold can be printed. And as a result, gold acts as a good hedge against the rising levels of inflation that we are going to have. So now that we have answered the question of why gold should be part of a well-diversified portfolio, the next thing you might ask is, how much gold should I hold in my portfolio? The answer to this can be visible in this diagram, where we are able to see that the Sharpe ratio is going to be maximized at somewhere between 8 and 14% allocation to gold. The Sharpe ratio is a return to risk ratio, and in simple terms, we want this ratio to be as high as possible. And as we can see, with a 0% allocation to gold, the Sharpe ratio is about 0.54. If you simply invested in the S&P 500 going back to 1970, and increases to about 0.6 with a 14% allocation to gold on the high end. So about 8 to 14% would be the optimal allocation to the precious metal. So now that we have answered the question of how much gold should be in a portfolio, this chart reveals how much gold do financial advisors actually own for their clients in their well-diversified portfolio. And as we can see, the vast majority of financial advisors, about 70% of financial advisors, hold basically no gold in their client's portfolio, and only 2% of financial advisors hold closer to the optimal allocation, which is somewhere between 5 and 10% of assets in gold. The last figure that we wanted to show with you is what does better in the long term, stocks or gold? This is a diagram from Jeremy Siegel's Stocks for the Long Term, and it shows data going back all the way to 1800. So well over 200 years worth of data. And as you can see, stocks have annualized at about 6.9% real rate of return over that time period. So stocks have definitely kept up with inflation. Gold, on the other hand, has also maintained its purchasing power. However, it has only annualized by about 0.6% over that same time period. Okay, so if your time horizon is infinite, your allocation to stocks should be 100% looking at this chart. However, most of investors' time horizon is not infinite. And as we said, gold has these unique properties, especially of negative correlation, that sometimes when stocks are decreasing, gold prices are going to be increasing and vice versa. And often our time horizon might only be 10, 15, 20 years. And that is the reason why we need to be well diversified. So I hope you learned a lot about gold from this very short video today, and we look forward to educating you further in our future videos. Till next time.